This chart is a thing of beauty. It's published by Morgan Stanley, and it shows the cash that midstream companies are returning to shareholders via dividends and buybacks. 5 years ago, pipeline companies rarely did buybacks. The Master Limited Partnership, or MLP philosophy, still prevailed. For decades, MLPs had generally been issuing equity to pay for new projects, but now there aren't many MLPs left. M&A activity means they're gradually being absorbed. Last year, ONEOK bought Magellan, Energy Transfer bought Crestwood, and more recently, Sunoco announced they're buying NuStar. Like their upstream customers, midstream energy companies have found that spending less on new projects is appealing to shareholders. Dividend hikes and buybacks are popular. Most of the companies in this Morgan Stanley chart have plans to repurchase shares. That means that on top of yields of around 5 to 6%, investors can also look for another 2% or so as they retire shares. The Magnificent Seven get all the attention, or I guess it's now the Supreme Six since Tesla's been dropping. But over the last 3 years, energy has been the best performing of the 11 sectors of the S&P 500. The pipeline sector, which is typically more stable than broad energy because it has less commodity risk, has beaten the other 10 sectors as well. Given how much attention the tech sector receives, I think many people will find this surprising. The good news is that even though we've enjoyed that outperformance, we're still attractively priced, as you can see from the dividends plus buybacks. CapEx is still half of what it was 5 years ago. Diamondback Energy is buying Endeavor, and they expect to reduce total rig count while still increasing oil production. Across the energy sector, the philosophy is to operate more efficiently. Energy companies are earning historically high returns on equity, while their weighting in the S&P 500 remains historically low. We mostly have the pipeline network we need. Climate extremists have raised the cost of adding new greenfield pipelines with relentless court challenges. This is imposing extra financial discipline. Remember, when you meet a climate protester, give them a hug and drive them to their next event. Investors sometimes ask why they should buy stocks when cash yields over 5%. Treasury bills aren't so bad nowadays. For the first time in many years, you can earn a rate above inflation, risk-free, but short-term rates are at a level the Fed regards as restrictive. At some point this year, they'll likely start cutting them. Meanwhile, we expect pipeline stocks will still be paying their dividends and buying back stock. Attractively priced, in favor with the discerning investor, deserving of a closer look. That's midstream energy infrastructure today. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.